Hey there, I'm Pete Townsend, and this is Money Never Sleeps. We look inside the minds of entrepreneurs and at the crossover of startups, enterprise, finance, technology, and life as we know it. This week, serial entrepreneur Nigel Eccles joins the show. Nigel is co-founder and CEO of BetHog, a crypto casino and sportsbook. And prior to BetHog, Nigel was CEO and co-founder of FanDuel, the leading U.S. sports gaming operator. In addition, he is co-founder and chairman of BetDex, the leading decentralized sports betting exchange, and is chairman of several online gaming companies, including Ray do Pitaco, Draftea, and Hotstreak. Nigel has a lifelong interest in building digital consumer products and helping early-stage tech entrepreneurs. In this episode, we explore Nigel's entrepreneurial journey, his philosophy on building businesses, and the lessons he's learned from navigating the ever-evolving gaming and betting industries. From launching over 10 ventures to building startup teams to raising over $450 million in funding, Nigel shares unique insights into what it takes to succeed as a founder, the importance of timing, and the evolving landscape of crypto and Web3. All right here on Money Never Sleeps. Nigel, listen, I usually start people with their backstory, right? To say, hey, let's bring the audience up to speed with where you came from, what you did before this chat leading up to today. But you recently posted your whole backstory on X, on Twitter.
Yeah.
And that was back in May. And you kind of said, listen, been getting a lot more connections recently and just wanted to share with everybody my backstory, basically. So in the spirit of not taking things too seriously, and I know you said that in the post as well, that's one of the things that motivate you is not taking things too seriously. Let's just speed run through this, okay? So you've been involved at the CEO, co-founder, or chairman level in more than 10 ventures with no end in sight, including Flutter/Betfair, FanDuel, Flick, StarStock, BetDex, BetHog, a new meme coin project, potentially, amongst others. Now, I'm trying to zoom out from this a bit. I talk to a lot of founders about having that long-term vision, and that long-term vision anchors you. And I ask them, what does the world look like when your product is an absolute necessity? I ask them how they're going to keep that long-term vision in mind while executing every single day. And I have this conversation over and over again with founders. But for you, with the number of ventures that you've founded or led, has there always been that long-term vision?
Certainly not a single long-term vision. I think a sort of central theme of everything I've done has been around delivering kind of online entertainment, particularly around speculation. That's always been my interest. I think the internet often can be very flat and boring. And I think throughout my career, I've always been interested in products that drive just a ton of excitement and interest. And usually that's around speculation.
Okay. So it's been more, listen, you want to make the internet more fun. You want to entertain people. There are ways to do that. There's a bunch of different ways to do that, but you've honed in on this one way to do that. It's just been a series of interconnected startups with this one vision in mind.
Yeah.
And the closest example I have to this is Connor Murphy. Originally did DataHug, and then sold that and now launched Bridge. And when I talked to him about the same thing, he said, listen, Bridge is just a continuation of DataHug, even though he had a huge exit with DataHug, and then took 5 years to do something else, started investing in startups, did some mentoring, and then off to the races then with Bridge, which was his next one. Not Bridge, the stablecoin infrastructure acquired by Stripe, but a different one. It's an interesting place to start. Speaking of getting a start, I saw that you grew up on a dairy farm in Cookstown in County Tyrone. And how did your upbringing there influence perhaps an entrepreneurial mindset? Did it?
Yeah, I'm not sure it really did. Like, I have 3 older brothers. We've all followed very different career paths. So despite having pretty much the same childhood, like, my dad was an entrepreneur. He was a farmer, but he had a lot of entrepreneurial activities, including growing mushrooms in the 70s. So we still had a house, which was called the Mushroom House. We actually still have it, which is where they grew mushrooms. So you could say there's like entrepreneurial trait in the family, but I'm not totally convinced that it just was something that I gravitated towards. I've of friends that I have of entrepreneurs, they just seem to have a very diverse set of childhoods. I'd always struggle to like draw a line and say, well, I'm this because of that. It just, I think it just happens. You know, I actually, for a while, like I was in academia. I actually worked in consulting for a while. Was it, I'm not sure if it was inevitable end up as an entrepreneur. Maybe it was, but I certainly tried other things as well.
Okay. This was looking back to, I think it was the Belfast Telegraph
Hmm.
in 2015.
Hmm.
And I think it was just a series of interviews that you had done at the time,
Hmm.
back when I think FanDuel had raised a lot of money.
Yeah, that's right.
On that point of raising a lot of money, Nigel, during your career, what I saw of public sources were pointing to you raising over $450 million in funding from
Hmm.
venture capital and angel investors.
Yeah.
Right now, I'm seeing founders struggle to raise, say, a $1 million pre-seed. And I
Yeah.
know that each time you do it, it gets a little bit easier.
Hmm.
But what was the formula for you at the
Yeah.
earliest days and then leading up to be able to raise that money across all these different ventures that you've created and founded and led?
Yeah. Honestly, the earliest rounds are oftentimes the hardest to raise because they're the situation, and particularly if you're a first time founder, you often have no traction. If you're a first time founder, you've no track record. The risk from an investor perspective is the highest. And you have no clue how to raise money, right? So it is. And like our first round was hard, or seed round effectively. I think it was like 2 million we raised. Then we raised another, was our Series A, which was very hard. Like I remember doing in-person pitches to over like 100 VCs. So it is hard. It kind of should be hard, right? Like if it was easy, I don't think we would have lots more quality startups, right? It should be hard, asking somebody for money. In terms of secrets of it, like I'm not sure there's anything that I can say that's not shared widely. Like the things that I've found are most important determinants of raising money. One of the top ones that maybe isn't talked about is timing. And I don't mean your timing, I just mean the market. If you were raising in 21, well, any idiot could raise in 21. Like there were like, people were raising 50, $100 million seed rounds, right? Whereas if you're raising in early 23 or late 23 particular, good luck. Like it didn't matter how good you were, much traction you were. It was really, really hard. The market's getting much better now. And so that's a really important factor. Second one then is just a sector. There are some sectors where I chat to entrepreneurs and they have, what I think is a really good idea. And I'm like, look, that sector's stone cold. I'd give you an example is like D2C, right? D2C, super hot in 21. Anyone could raise money, or actually even before that, 2018, 2019, very hot sectors. Today, really tough, like really hard to raise money. Hasn't been a lot of success stories. And the interesting one is it doesn't mean it's a bad business. It just means that sector's not hot. Investors are not investing in it. If we look at connected fitness, when Peloton was riding high, super easy to raise money there. But then when Peloton bombs, that whole sector just shut down. But funnily enough, now we have a ladder which is doing incredibly well. And I'm sure they had a nightmare raising because they were growing at a time when the sector was written off by VCs. So that's something to really bear in mind. And then after that is just the classic ones, which is what is the founder's track record? What your traction do you have? Those are kind of the normal ones that people look at. But timing and sector are actually the most important factors.
Yeah, I'm definitely seeing that right now. And the D2C element is always interesting from a crypto and Web3 perspective, right?
Mm.
Because so much of that is D2C.
Right,
And
correct. Yeah.
that if you're not D2C, that means that you probably don't need a token. And if you don't need a token, that probably means that Web3 VCs don't want to touch you.
Yeah, well, certainly for true Web3 VCs,
Yeah.
they pretty much are only investing in things that have a token. And that makes a massive sense from a financial perspective, because what we're seeing is projects are launching like without product market fit,
Hmm.
but they're launching to like massive FDVs. And so investors are getting 10x, 20x or more multiples on projects that haven't been successful or certainly not successful yet. And so there's definitely a discontinuity in these valuations, which means that like, if you're a crypto VC, you only really invest in projects that are going to have a token.
I was talking to we'll call him a pure Web3 VC,
Hmm.
uh, a month ago,
Hmm.
who said that it actually goes further down into their channel, which is that the expectation of the LPs of a Web3 VC is
Mhm.
that they will get quicker returns.
Right.
They will get a
Yes.
2 to 3 year payout rather than a 5 to 6 year payout.
Absolutely.
And
And
so
it, if
that's pushing the VCs themselves who may look at a project and say, you know what, that doesn't really need a token, to
yeah,
say, well, in some way, how could a token actually help you? And then we
yeah.
get into that whole cycle.
Yeah, so you kind of get what happens, you see, is that you take a project. I'm actually looking at one at the moment, and we're like, I don't think we need a token. We've got
Yep.
a really interesting product, but having a token just opens up so much opportunity that you're like, how would we put a token into this and would it really make sense? Yeah, just a point on timing. So FanDuel originally started in the fall of 2007. Investors didn't actually see, and this is a phenomenally successful company, but they didn't actually see any return until the earliest 2022. So it's
Wow.
15 years. And
Wow.
that is a big success story. So that's 15 years. It's a long time. We're seeing with crypto projects where investors are getting liquidity within 2 to 3 years.
Yeah.
So you can see the attraction.
Yep. You definitely can. In terms of how you've navigated this whole space and navigated all the fundraising rounds, is there anything that you've learned to stay away from in terms of what may be contained in term sheets and shareholder agreements during the earliest rounds of fundraising that you think have proven to be helpful at the later stages? You're like, oh, I'm glad I put that in, or I'm glad I
Yeah.
negotiated hard for that. We know that the VC mindset is all about economics and control.
Yeah.
So anything there that you think
Yeah.
is was helpful?
Honestly, I actually would look at it. What I've learned is more a different way, which is, and to some extent, the term sheet doesn't matter. And just to put it in
Yeah.
this way, and the reason I say it doesn't matter is if you're getting an investor onto your cap table who doesn't have the right ethics, then the term sheet kind of doesn't matter, right? And by that I mean if they're not founder focused, if they just don't have good business ethics, right? Or just ethics in general, they will spend their time trying to find a way to enrich themselves at the expense of everyone else and even to destroy the business. And so a lot of time people like focus on negotiating the best term sheet when I think that really what they should be focused on is getting the best investors on board. And the sort of corollary though is that the best investors are not looking to put in predatory terms into term sheets.
Hmm.
Like I realize like we obviously will negotiate around certain terms, but to a large extent, I'm like at this stage, this is someone that I trust has proven to be trustworthy. I've due diligence and spoke to entrepreneurs and said, look, whenever things went bad, as often they do in startups, how did they behave? Like how
Mm.
did they treat you? Were they genuinely supportive? Or did they use it as an opportunity to basically screw you over? And it comes back to that, which is like, yeah, like your terms could say anything, but if you're in a situation where you're running out of money and the only person at your cap table is one of these predatory investors, then the things that you've negotiated before don't matter. All
Hmm.
right. All that matters is now that they're going to get whatever they can. And are they going to use this as an opportunity? Are they going to stand up and support the company, or are they going to like use it as an opportunity to totally screw the founders and the employees? So that's why I always kind of counsel founders, which is spend less time thinking about negotiating some of these terms and more time making sure that the people you're bringing up the cap table are people you want to work with the next 10, 15 years.
Yeah, that's a great point. And just to double click on that, that founders at the earliest stages, hopefully they've got a good network.
Mhm.
Sometimes they don't always do. Sometimes they
Yeah.
don't have connections to the portfolio companies
Mhm.
of the VCs that they're talking to.
Yeah.
And do you suggest, hey, just go through the VC to get an intro and make it clear that you're doing some reference checking? Or do you say, hey, leverage your network, find a way to get a chat with one
Yeah.
of the portfolio companies of that VC firm or more, multiple
Yeah.
ones, to try to get a take on this?
Yeah, I always do both, right? And like if you can backdoor check, it's always best. But if you go to VC and say, "Hey, I'd like to speak to like these," yeah, you can ask them to give you ones, but you can also like look at the ones in the portfolio that might have gone through a harder time and say, "Hey, I'd like to chat to these CEOs." And if you get if you interview a candidate and you want a reference and you get a highly evasive, well, there's a story there, or like, we'd rather not. Like, that's kind of, okay, that's
That's
a
a
good
tell.
side, right?
Yeah.
That's a tell. No one ever, or very, very rarely gives up somebody who's a bad reference, right? But if you find somebody who should be a relevant reference and they don't want to give it to you, well, that's a tell.
Yeah.
And, I will say early stage generally it's a lot better now than it was. I think the instance I know, particularly in early stage, it's pretty low. It's very low because if you want to be an active early stage investor, you just can't really afford to sort of screw over founders, right? Like it is a small industry. Typically, the issues are more at later stages. That's where, like, nearly all the founders I know that have run into issues, nearly everyone will say, like our seed investors are fantastic. It's the later stage. It's usually a
Yeah.
common issue. Even at later stage, there is plenty of investors I've worked with who are, and friends of mine that have worked with when things get hard. Because hey, everyone can be a cheerleader when everything's going well. The question is when things aren't going well, how do they behave? And there's plenty of late stage investors I've worked with who fantastic and very supportive. And so again, even there, it's rare, but there are people who are predatory.
Yeah. Yeah. Got a VC friend of mine who said he had been doing mostly pre-seed and seed.
Mm.
And then when the firm that he was working for decided to go late A into B, he said that, listen, he was used to everybody at the pre-seed and seed stage level just being so congenial amongst
Right.
the investor
Well,
base.
everyone at that stage is much more aligned,
Yeah,
right?
totally.
And it's the later stage where, like, early stage is all about how big can we make this pie, right?
Hmm.
Later stage becomes much more about how do I make sure that my bit of the pie is much bigger, right? Because it's less about how do we make the pie bigger. And then that's where it makes it less, yeah, it's just more sharp elbowed, shall we say.
Yeah, that's exactly what he said. It's sharp elbows that
Hmm.
people were, that he wasn't used to being in that kind of
Yeah.
environment where he had to be a lot more watchful of his own back when it
Hmm.
came to doing these kinds of deals. So lots to navigate there. You mentioned a couple minutes ago when we're talking about VCs, you mentioned ethics, trustworthiness, those types of things.
Hmm.
What are the things that you look for in co-founders, given how many of these ventures that you've launched, and
Hmm.
early team members
Hmm.
in terms of their qualities?
Yeah, it's a good question. Like I always like Paul Graham's comment is that co-founders is like location and property. You can change absolutely everything. You can change everything about the house. You can knock it down, rebuild it. And it's the same with startups. Like you can change product, you can change industry, you can change everything, but you can't change your co-founders,
Hmm.
right? It's just sort of like a fundamental to the success of a business. I think it is important to have co-founders. Solo founded startups are a real exception to the rule. There are a small number, and I know of a few successful solo founders. I would not recommend it. Ideally, you need a co-founder. Ideally, you're looking for someone who balances yourself. So if you're strong on the business side, that you have somebody strong on the technical side. In fact, I would go far to say is if you're a tech startup, you need a tech co-founder. Like
Hmm.
it's almost impossible. There's very few examples where one of the founders was not at least couldn't at minimum code a bad version of the early product, right? They don't need to be a technical genius unless it is a deep tech startup, but them being able to build the early product is important. In terms of beyond that, the key factor are things like can you work together?
Hmm.
It sounds like a small one.
How long does that take to figure out?
I don't know. It usually takes about a year or so. Yeah, like most founder fallouts happen within like the first year or so. If it helps if they're brilliant at something, right? Like, let's be real, like startups are really hard. I was really fortunate the founders I had at FanDuel, they're a combination of just amazing marketeers, a brilliant product focus, brilliant designers. So you want to aim really high, right? When people are saying, well, where do I find these people? I always sort of say, well, the best co-founder and the best hires are always people who come out of failed startups. It's like the absolute hunting ground for anybody looking for really high quality talent because most people who've never been in a startup before absolutely fail at being able to just exist in an environment where there's no structure, no one's telling you what to do, nothing works. and you can't blame somebody else, right? Like it's just like it's just not working. And so if you find somebody who's been in that environment and it's gone through the sort of hell that a failing startup is, and then says, "Hey, I want to do it again," well, that's a really interesting candidate. Now, you probably do want to dig into why it failed. Like if it failed because they made terrible decisions, then you probably don't want to work with that person. But most startups don't. Most startups fail because they usually fail because somebody tried really hard to make something happen and sweat blood and tears and it failed, right? Because
Yep.
most startups fail. But if you can find people like that, those are the people you really want to work with. You definitely want to avoid people like the failure rate of people who come out of like a FANG, like a Google,
Mm,
who wants to do startup
yeah.
is really bad. Really bad indicators are people who want like a big salary out of the gate, people that care about status, people that have seen other people be successful in startups and want to, want a bit of that. Very, very high failure rates. Now, I'm not saying everybody coming out of FANG is not going to make it. You're really rolling the dice if you're their first startup out of a big company.
Yeah. Yeah. I see that a lot where I'm looking at decks and
Mhm.
talking to founders and where the team is not yet fully committed. The CEO is fully
Mm.
committed, but they may have one or two co-founders and you'll
Yeah.
find them coming out of a FANG.
Yeah.
And the question I always ask is, okay, when are they going to be full time?
Mm.
Well, they'll be full time when I raise.
Yeah.
And that's because you got to replace that FANG salary,
Yeah. Yeah. Yeah.
and if that's necessary,
Yeah.
when you show the VC your financial projections and you got like a huge, gigantic FANG salary on
Yeah.
a
Yeah.
pre-seed stage startup,
Yeah.
not going to work,
Yeah.
you know?
Also, just like that's not a co-founder, right? Like, because
It's
they're not
not.
taking any risk, right?
Yep.
If someone's not willing to stand up and say, well, unless somebody else is willing to go out and get me 2 years runway, then I'm not joining. Then they're an early employee. Great. But unless you're willing to take risks, you're not really a co-founder.
I like that. That's a great way to look at it. Cool. Kind of shifting gears a bit. Post FanDuel,
Hmm.
okay? I saw Starstock. I saw
Hmm.
Flick.
Hmm.
Obviously, BetDex, now
Hmm.
BetHog as well. In that you coming out of FanDuel were in a much different market environment in terms of where the technology
Hmm.
space was.
Hmm.
And with the growth of digital assets, blockchain,
Hmm.
crypto, Web3 wasn't a term yet when you came out of FanDuel. You had all these different tools there for you to think about in terms of the next value proposition that you're going to put in front of this market
Hmm.
that you've just become so used to serving during your
Hmm.
time as a startup founder. That how did you go about identifying and validating the opportunities given this whole new space that had emerged
Hmm.
now that you were back out in the open?
Yeah, I don't like validation is really through trial with new concepts. If it's really you, like it's not been proven elsewhere, the only way to prove it is to build it and to see if people like it. There are shortcuts in a way sometimes, which is in this market, are there people using bad versions of what we want to build, right? That's always a really good sign. If people aren't even using a bad version, there's always a trap that founders can fall into, which is, well, I need to build the perfect version. And when we do, then people will use it, right? And that almost never works, right? Like, because you just discover there's no demand. If there's a lot of demand, then people will often be willing to put up with something that's not very good. And I even give the example of FanDuel. We weren't the first person to do like daily fantasy sports. There were other products out there that were really bad versions of FanDuel. And they had a lot of interest. Like people were playing them. They were fun games. I played them and I'm like, this is fun, even though it's terrible. A really bad product. And so when I look at new startups and consumer in particular, I'm always like, well, I don't really want to take the risk that I spend 2 years building this and no one actually wants it. I
Hmm.
really want to see, are there analogs of this today that are just bad? And also, I need to understand, are they bad, right? There's certain things that people think. I'll give you a great example, which is like WhatsApp. WhatsApp's a very basic product, right? And you're like, oh my God, it's very basic. It doesn't support like picture libraries well. It doesn't support threading and groups and all of these things. It's just bad at them, right? And so we actually built a product that did all of those things much better. It was more like kind of like a consumer version of, say, Discord or Slack. You had multiple channels, it handled media. And when we thought, hey, this is better, like surely people would come over from like WhatsApp groups to this product. What we discovered was that WhatsApp actually was amazingly good at what it did. And what WhatsApp did was it is available on every phone. Every phone can download it. It's a very small application size and it works on every phone back to like the iPhone 1. If you have a group of 20 people, you're going to have one person that has like an operating system from like 10 years ago and they can't upgrade because they're out of memory.
Yeah.
and and
Yeah.
they and so you can't get them to switch to a better app. And so suddenly, so what that means is for to have a group app for this group, it has to work for every phone. Like people may be on BlackBerry, and I'm sure WhatsApp still works on BlackBerry. It
Mhm.
works everywhere. And so what we thought was bad, but didn't have all of this functionality, we were wrong. The users had optimized for what they wanted, which is available everywhere. And they didn't really care that much about, oh, it'd be good to have like, picture galleries and stuff like that. So it's very important when you kind of start to look at, when you look at a market to understand what is good and what's bad, what users really care about, and not just sort of project onto it things that you think might be bad and how to make it better.
Okay. And what were the things that you identified in the market with BetHog where you said, listen, this is something that we're going to go ahead and do?
Yeah. So a couple of interesting things we thought about online casino, and we're still proving this out. Like this
Yep.
is something where we could be wrong, but we sort of feel pretty good that we're right on this. Is that over the last 10 years, or 5 to 10 years, streaming has just become a huge phenomenon. Originally, streaming for gaming, so people playing League of Legends, Overwatch, Fortnite, and streaming it, highly entertaining. Then you've got sort of just chatting streams. And we've got the rise of like podcast stroke streamers like Aiden Ross and a whole list of them who went on to interview the future president. They've become a phenomenon. But we've also seen that in online gaming and online betting. So on originally on Twitch, but now on Kick. But we also see it on YouTube where people are playing casino games and streaming them. And it's become a really big phenomenon. It's become a really big channel for casinos. The thing that we thought was weird was the games themselves haven't evolved. So where are people playing the same five real slots games that you could have played 20 years ago on a totally new media format? And we were like, what if we started with the stream and this format and said, what if we design games for the streamer? What if we design games with that play style in mind? So it's not a single person sitting in front of a single laptop betting on a single game. It's actually someone betting with an audience there. How would we redesign those games? And what we came up with was, well, I think the audience would like to play along, be part of the experience. And that's what we've built. And so a couple of our titles, so one of our titles is a product called Hogger. So when the streamer bets, Hogger is a play on Frogger. It's you start with a peg at
Hmm.
the side of the road and you have to try and get the peg across the road. But what we did is we said, okay, when the streamer starts playing, the streamer's fans or the people who are watching can then bet on the streamer. So the streamer wins, they win. Streamer loses, they lose. And so that's a title we launched a couple of weeks ago. It's been very popular. So those are kind of the ideas that we are evolving, which is, okay, something's changed here. The thing that's changed is it's not all solo play. It's actually people playing with other people, with friends or streaming it. How do we actually design games for that and then run with that?
The hamster is running in my mind, or the
Hmm.
hog in the little wheel is running in my
Yeah.
mind. And I'm thinking about esports platforms
Hmm.
today and how you've got, yeah, people watching gamers on
Hmm.
YouTube. And then you get all of those gamers into a big esports tournament.
Hmm.
Obviously, sometimes in a physical location with some of the
Yeah.
sponsorship
Hmm.
models that are there. Sometimes it's totally virtual,
Hmm.
but then you get an audience there.
Hmm.
So let's open up those major esports tournaments
Hmm.
to betting.
Yeah. So interestingly, that's a lot of that has been tried and
Has it?
it's not had as much success as you would think.
Okay.
Again, you have to get really deep about what people are watching and what they want to do. So betting on the next event in esports hasn't really delivered as much as
Okay.
people think. And there's sometimes somewhat complex reasons. I'll give you one thing that we find is when people look at sort of FanDuel, so FanDuel's a daily fantasy sports product. Sometimes people would say, well, wouldn't it be better if you could actually play during the live event? If you could actually trade players during the live event? And I was skeptical of it. And we saw a number of startups try and do it, and none of them worked. And I actually think the reason it didn't work was something we identified early on, which is fantasy sports actually is much more about the time before the event than it is the actual event. Because one of the things about a sports fan is, let's just take NFL. I know between 1 p.m. and 11 p.m. on a Sunday, Eastern, it's the best time of their life.
Yeah.
Football's on. They're sitting watching football. Everything's great. When's the worst time of their life? Tuesday afternoon, right? Like, there's no
There's
football
nothing
on.
on. Yeah.
There's nothing on. There's no game for another 3 days, right? And when's fantasy really popular? Tuesday afternoon, right? Launching a product or having a product that's saying to them, hey, you have to play this now on a Sunday when they're happy, they have a beer in hand, they're with their mates, they're in the pub, wherever. Like, you know, that's the wrong time to be trying to get in front of them and say, hey, play the product. FanDuel did great on Tuesday, right? It did great on Tuesday and Wednesday. People were putting together a roster. They had high dopamine because they were anticipating this amazing fun weekend they're going to have with what an amazing roster we're going to put together. That was FanDuel. It was that anticipation. One of the things you just need to be careful about is if I'm really into League of Legends and it's the finals, and as a game developer, and you're saying, hey, to make it even better, I'm going to make you be distracted from just watching and enjoying the game
Mm,
or the event, that's probably not going to be a great product. And
yeah.
so you really have to get down in front of the users. And it's dangerous if you're not a user, right? And it's also even more dangerous, I would say, is if you're a typical user. And by that, I mean, some people are into esports and they do want to bet on it, but the more mass market do not, right? And so we've seen that. We've seen products like that were developed for people like themselves, but we discovered that they're not a typical use case. And so that's something that's really important is like really getting down and understanding your target customers and seeing, is this a product that they would use, or actually is it a negative?
Yeah. I asked my kids, and I had a Web3 sports proposition put in front of me the other day. I got very excited about it, and I explained it to one of the kids. He's like, no. He's like 12. And
Mhm.
you're right, because they spend so much time in front of a screen, they just kind of have a feel for this.
Mm.
And now that you mentioned about this esports,
Mhm.
hamster that was running through my mind, that,
Mhm.
yeah, when the kids watch streaming, they're usually not watching it live.
And often they're
They're
doing,
watching it on YouTube, like
yeah,
at their leisure, at
yeah,
whatever hour they want to see,
yeah,
hey, what was the latest game that this guy
yeah,
played and how did he do? And you can't bet on that. It's already
yeah,
passed.
yeah,
Not that I want my kids to bet, but
yeah. And
well,
also
they don't have any money to bet because I don't give
they're
them
on
enough.
they're on Discord, and they're also on Twitter, and they're checking Instagram, and they're doing like 5 other
Exactly.
things. So
Exactly.
yeah, it is super important. And like it's not easy, right? You have to try and really dig in to find the insight, but it's always kind of dangerous projecting other paradigms onto a use case and say, well, this worked in traditional gaming, like why wouldn't it work here? And actually you find that the users are very different.
Yeah, they are. They are. I always like to say to founders that, listen, if you're not building for users or customers, you're building for yourself.
Yeah.
So go out there and talk to them, please,
Yeah. Hmm.
before you build anything.
Yeah.
Get into that mindset.
Yeah. I don't think it's not terrible to build for yourself, but you need to be a big market. Too often, I think people build for themselves and then they discover that the, they don't represent a big market. And that's often the challenge. Like in fantasy sports, the number of people who had startups that had the most complex kind of rule systems that they and their friends loved. And I was like, yeah, it's pretty unique.
Yeah.
FanDuel was designed deliberately to be simple, that the biggest mass of people could, want to play. That was a deliberate design criteria.
Why do you think that in the betting space now online that people aren't trying to differentiate more?
Well, like one of the things I say with the betting space is it's a very successful industry.
Yeah.
So, and that's not a given, right? So, as industries I've worked in that are not successful, they're not innovating either. If you're successful, then you're like, well, why change? Like,
Yeah.
things are good. I think there's a number of things. I think there's been like reasonable innovation in the crypto space, like Shelf or Stake, for example, has really pushed provably fair crash games. I think been very successful with those. So I certainly think there's been some innovation. There's been a lot more outside of the crypto space in the regulated market. That one's just been really tough because you just can't win. So, for example, in the US and even in the UK, no one is winning, certainly in the last 10 years, through product innovation. Like, this is not a market where someone came along with like, they had a great product insight, they built that product and they took market share and now they're a leader, right? Like, not in the last 10 years. Like, FanDuel and DraftKings obviously are, but we started in 2009. In the last, and certainly in the US regulated market, that's not happening again, right? Like, there's no one is going to challenge FanDuel and DraftKings. It's dangerous to say no one, but I would happily bet on it.
Mm.
No one's going to come up with this great product innovation that could steal share. And that also hasn't happened in the UK. Like, it's not like, if we look at the biggest sports books in the UK, they're all ones that were largely started 15 plus years ago. There hasn't been like product innovations that have just sort of really taken market share, like we've seen in other markets, like even like mobile phones or other, markets where we've seen real sort of innovation and people taking share.
Yeah. Yeah, I know. Just out of curiosity, did you ever work with Bradley Tusk?
Yes, I did. Yeah, yeah.
You did.
They
You
did.
did.
Yeah,
Yeah. I
yeah.
thought I heard him talking about FanDuel once.
Mhm.
He was guest number 33, I think, on the show way
Mhm.
back when in 2018. So, and
Yeah,
I've stayed in touch with him. Shout out to Bradley. He's a good
yeah, yeah.
guy. Been
Absolutely.
helpful.
Yeah,
Been
yeah.
really helpful. And talk to him about the betting industry and
Mhm.
obviously then kind of the next thing
Mhm.
from a regulatory perspective. He went taxi deregulation with Uber, he
Yeah.
went betting and then crypto and saying and crypto is an interesting beast because the anti-crypto regulation wasn't there. It was just an absence of regulation.
Yeah.
And hopefully now we're getting the regulation that will be helpful.
Yeah, well, crypto had again a little, honestly, like a little like fantasy had in the US, had an absence of regulation. Under the current administration, it continued to have an absence of regulation, but had regulation by enforcement
Yeah.
of poorly conceived laws that didn't really apply to it. And it acted as just a massive brake on the industry where like we had the leading operators who hire armies of lawyers to stay compliant getting sued by the government. Like these are entities that try to do everything to be compliant and they're getting sued. And so you're like, what sort of industry is this that the government is just try to kill it? And so, yeah, we're definitely like the election has been a massive boon for crypto. And I think everyone in the industry hopes that, like, look, in the next 4 years, maybe we can get reasonable legislation that both protects investors and users of these products, but also allows capital formation, allows entrepreneurs to innovate. That's a hope. Let's see if we get there.
Yeah. Well, it's interesting because we've got the latest around Operation Choke Point 2.0.
Yeah.
Shout out to
Hmm.
Nick Carter for coining that term.
Hmm.
Went after crypto. And
Yeah.
then Operation Choke Point 1.0, the original one
Hmm.
during the Obama administration, went
Hmm.
after your industry,
Yes, right.
amongst
Yeah,
others.
yeah. Yeah.
Right.
So
So,
it was quite funny in crypto because obviously this is the first time it had happened to people in crypto, but actually coming from gaming, I'm like, yeah, like having the government go after payment providers, having the government shut down domains, like we've all experienced this before or criminalize an industry. We knew the government did it. I think gaming, it actually was a precursor to obviously choke point 2.0, that the government realized, hey, we could do this. We don't actually ever have to stand it up in court. We can just, and like the gaming industry really was on the back foot for many years. That gave birth to choke point 2.0.
yeah. But gaming industry survived and is doing
Yes, it
well.
did. And so is crypto.
Yeah, exactly. We'll get through this.
Mm.
Thinking ahead to the future, Nigel,
Mhm.
what are you most excited about in this space?
Most excited about crypto is such an exciting technology. I really get excited about letting people own and control their own assets again. I think people, until they have that experience of self-custody and when they first do transactions and they realize that, like a little bit, there's no guardrails, right? For some people, obviously, it's kind of terrifying. I think for a lot of people, they feel it's really liberating. Like they don't have to, call up their bank and then their bank say, "What's this for?" And really, what you want to say, it's for none of your freaking business. Like it is literally my money. Like
Yeah.
I don't really know how to explain this to you guys, but it is my money. And I don't have to explain it to you guys, but you do.
Mhm.
Like I think people, like, and we see the gaming sector in the UK, why should I have to give my bank statements to a bookmaker?
Yeah.
Like the level of invasion of privacy there is obscene. Like, so I find crypto an incredibly liberating technology. I think that it is, I think some of the frustrations I have with it is it hasn't become more consumer friendly.
Mhm.
Like today, I talk people through like setting up their wallet and like, oh, don't do this because you'll lose all your money immediately.
Yeah. Yeah.
Don't click on these links. And I'm a little bit disheartened that we've not seen more progress in the last 3 or 4 years. Like there has been some good progress in crypto, but in a lot of sides from the consumer side, we've not. Like we've not seen fantastic Web3 games. We've seen better wallets, but I don't really feel we've seen brilliant wallets. Like not ones that you would really want to put your grandparents on. And that to me is kind of frustrating. The
Okay.
things that I'm excited about though is just continued improvement there, like having more people own crypto. Every time we have a bull market, more people come in. There's always progress there. It's just, we could see it'll happen a little faster.
Definitely. Yeah. I'm seeing a lot. I've seen through Techstars now, probably over the
Mhm.
last 3 years, 2,000 deals.
Mhm.
I'm seeing tons that are focused on the app, what I just call the application layer. And those are
Mhm.
making it easier for
Yeah.
people to get involved in this space. So
Yeah.
it's encouraging. But
Mhm.
those are things that out of those 2,000, 10 might make it. So
Yeah.
and one, if that may be in this space of making crypto more accessible for people. So
Yeah. Yeah.
but we'll get there.
Mhm.
I'm going to round this out, Nigel, where I round out every episode that I do
Mhm.
with people, which is, what is one thing that people would not expect to know about you?
Well, one thing people probably don't know about me is I have a side interest, which is in a fairly obscure topic, which is medieval warfare.
Ooh,
And for many years, I've had an interest in it. I actually have a master's degree in operation research, which actually is how to simulate. Well, some of the stuff that I research is how you would simulate a lot of it. And actually, as a sideline, I've been developing a game for sort of actually a couple of years that I'd hope to launch next year. So it's a mobile game that is kind of a simulation of medieval battles.
wow. I did see something in your university experience
Yeah.
on military combat or
Yeah.
something to that effect. So
Yeah.
was wondering, wow,
Yeah,
that's deep.
there definitely is it's been on the back burner for years. It's not a commercial project, but it's something that I've desperately wanted to build. And only really in the last 6 months did I actually put everything together and get it into development. So we should have a playable product by January, but not a release candidate. And certainly I'd hope by Q2 next year, we actually might have a release candidate.
Awesome. Yeah, it's sometimes just those passion projects that become the project, but we'll
Yeah,
see.
absolutely.
All
We'll
right.
see.
Well, listen, Nigel, thank you so much for coming on to the show. It's been a
Thank you.
great chat.
Yeah, you
Really
too.
appreciate your time.
Thank you.
That does it for this week, folks. Thanks to Nigel Eccles for opening up his mind to help us figure out why he does what he does. Check out the show notes on moneyneversleeps.ie for all the relevant links to learn more about Nigel and the businesses he's founded. If you like what you heard, please leave us a rating and a review on Apple Podcasts or Spotify as it helps others to find the show. Also, thanks to Conan Brophy from Create Sound for mixing and editing this episode. Conan is an excellent media man to get in touch with when you're thinking about launching your own podcast. As for me, I'm an early stage startup investor focused on where fintech meets crypto and crypto meets Web3, and I lead the Techstars Web3 Accelerator. There are plenty of links in the show notes on moneyneversleeps.ie on how to get in touch, so don't hesitate to reach out. Finally, until next time, thanks for listening. See ya!
Money never sleeps, pal.